Welcome back to the Daily Crypto Roundup. It's Thursday, October 30th, 2025, and the crypto markets are closing out one of the most turbulent weeks of the year. After a brief rally early in the week, we've now seen the wind shift again. The Federal Reserve's cautious tone yesterday sent tremors through global markets, knocking confidence and trimming risk appetite across the board. Bitcoin's holding steady around $108,000, but the volatility is still intense. We'll get into all of that shortly. Today's stories paint a full picture of where we stand in this critical phase of the cycle. We'll start with the fallout from the Fed meeting, why markets have dipped again in the last 24 hours, and how analysts are interpreting this as a potential setup for the next major move. Then we'll turn to Norway, where the National Tax Authority has revealed a 30% surge in declared crypto holdings. An unexpected milestone showing just how far mainstream adoption has come in Europe. After that, we'll look at the new altcoin ETFs just approved in the United States. Canary Capital and Bitwise breaking ground with the first Solana, Hedera, and Litecoin spot funds, signaling a new era for institutional crypto investing. And finally, we'll break down a report on the State of Crypto 2025, a study that suggests crypto is transitioning from speculation to participation. 4 stories, 1 thread. The market may wobble, but the infrastructure, the regulation, and the adoption curves are all moving in one direction: forward. Before we get into the details, if you're finding value in these updates, hit follow, leave a 5-star rating, and share the show with a friend. It helps more than you think and keeps independent crypto journalism alive. All right, let's start the day where we always do, with the top 10 coins. Bitcoin trades around $108,000 after an intraday range between $112,000 and $107,400. Ethereum sits just under $3,800, roughly $3,780 at the time of recording. XRP is holding near $2.46 after yesterday's brief jump toward $2.65. Binance Coin is steady at $1,079, while Solana trades around $185 after tapping $199 earlier in the week. Cardano sits at roughly 60 cents, Dogecoin around 18 cents, Chainlink near $17, Litecoin at $92, and Stellar rounding out the top 10 at 29 cents. Across the board, it's a mixed session, mostly small declines, but the key story isn't price, it's positioning. The Federal Reserve has just given markets a reminder that the era of easy liquidity is over, at least for now. The central bank's latest meeting delivered exactly what traders expected, a steady hand on rates. But what shook markets was the tone. Jerome Powell signaled caution, not conviction. The message was clear. The Fed isn't convinced inflation is fully under control, and it's not ready to declare victory yet. That single nuance was enough to send risk assets lower. Stocks dipped, bond yields jumped, and Bitcoin lost around 4% in a single session. But if you talk to analysts, they'll tell you this pullback is more shakeout than breakdown. Marcus Thielen from 10x Research called it the feint before the follow-through, a short-term flush designed to clear excessive leverage before a broader rally. And that's exactly what seems to be happening beneath the surface. On-chain data shows that long-term holders are still stacking. Addresses holding over 100 Bitcoin have increased by almost 2% since last week's low. Funding rates have cooled, leverage has been flushed, and spot buying from institutional desks has quietly picked up again. History suggests this is textbook consolidation after a macro shock. In late 2018, the Fed made a similar misstep. It tightened into weakness, markets sold off hard into Christmas, and Bitcoin dropped over 40%. But within 6 months, both equities and crypto had fully recovered. That same playbook might be unfolding now, a painful reset before a fresh liquidity wave. As one trader put it this morning, if you're watching the charts, it looks messy. If you're watching the supply data, it looks bullish. And that's the paradox of this moment. The macro optics are dark, but the structural indicators remain some of the strongest we've seen all year. Now a quick word from our sponsor. In a world shifting from paper to code, control is everything. Ledger gives you that control. It's the safest way to store your Bitcoin, Ethereum, or any digital asset offline. Out of reach from hackers, exchanges, or regulators. You can check out the official store. Link is in the description. Now let's move to Norway. where a quiet revolution in transparency has just made headlines. Norway's tax authority has reported a 30% year-over-year increase in declared crypto holdings and transactions. That might sound like a bureaucratic footnote, but it's actually a milestone moment. For years, regulators in Europe worried that the majority of crypto activity was happening under the radar. Now, compliance data shows the opposite trend. Citizens are voluntarily disclosing holdings, integrating crypto into their financial reporting, and treating it as a legitimate asset class. This kind of shift matters because it changes the political equation. When tax agencies see higher compliance, they stop viewing crypto as a threat and start viewing it as revenue. That creates a virtuous cycle: better data, friendlier regulation, and a smoother path for institutional adoption. Analysts across Europe see this as a validation of the MiCA framework, the EU's new digital asset law that came into force this year. It's designed to bring stablecoins, exchanges, and digital assets into a unified rulebook. And while critics feared it would stifle innovation, Norway's results suggest the opposite. Regulation done right encourages participation. As one analyst in Oslo put it, the numbers don't lie. When people trust the system, they join it. From regulation to investment, let's talk about the biggest institutional development of the week. The SEC has approved a new batch of spot ETFs from Canary Capital and Bitwise Asset Management. This time not for Bitcoin or Ethereum, but for Solana, Hedera, and Litecoin. These are the first altcoin ETFs ever authorized in the United States, and their approval marks a major evolution in how traditional investors access crypto. Each fund is designed to track the spot price of its respective asset, held in cold storage and audited quarterly. The move comes just months after the Bitcoin and Ethereum spot ETFs shattered records with billions in inflows. The message is unmistakable: regulators are slowly thawing. Institutional analysts call this Phase 2 of ETF adoption. Phase 1 brought in generalist capital, big funds looking for simple exposure to the majors. Phase 2 brings in specialists, tech funds, thematic ETFs, and portfolio managers who want exposure to blockchain performance layers like Solana or enterprise networks like Hedera. If Phase 1 was about validation, Phase 2 is about diversification. Solana in particular is expected to benefit most. Its speed and low fees make it attractive to traders and developers alike, and it's already handling daily transaction volumes on par with Visa. A listed ETF could pull fresh liquidity into its ecosystem at the exact time when retail enthusiasm is returning. Meanwhile, the Hedera ETF is more of a long-term play. Institutional infrastructure, not hype. And Litecoin, though often dismissed as digital silver, could surprise with its longevity and regulatory clarity. The key takeaway here isn't that altcoins are going mainstream. It's that Wall Street now sees crypto as an investable asset class with layers, sectors, and diversification potential. Now let's turn to our final headline: the A16Z State of Crypto 2025 report. This year's edition reads differently from any before. The headline isn't about prices or hype, it's about participation. Andreessen Horowitz found that mobile crypto wallet usage has grown 20% globally, and mid-sized holdings, balances between $1,000 and $10,000, have jumped nearly 40%. That suggests that crypto ownership is no longer confined to early adopters or institutions. It's moving into the middle class. The report's lead analyst, Eddie Lazarin, summed it up best. Crypto has transitioned from speculation to participation. People aren't just trading anymore. They're using crypto to save, pay, and build. What's more, the study found that in countries with inflation above 5%, adoption has doubled in the past 2 years. Stablecoins like USDT and USDC are becoming the de facto currencies of commerce in parts of South America, Africa, and Southeast Asia. That's not a future prediction. It's happening now. So while Wall Street debates the next ETF, the rest of the world is quietly rewriting how money moves. There's no getting away from it. It's been a tough month, so let's round this out with some perspective. If you zoom out on Bitcoin's history, every major drawdown has followed the same rhythm. In 2013, Bitcoin crashed 70% before tripling within a year. In 2018, it fell from 20,000 to 3,000, only to rebound to 14,000 within 12 months. In 2022, after the FTX collapse, Bitcoin dropped below 16,000, and by mid-2024, it was above 100,000. That's not luck. That's the cycle doing its job, transferring assets from the impatient to the patient. Analysts like Mike McGlone from Bloomberg Intelligence have been emphasizing that volatility in crypto isn't a flaw. It's the mechanism of price discovery in a new monetary system. Each cycle compresses the timeline between panic and recovery. What once took years now takes months. That's why, even after a week like this, the outlook remains resilient. Inflation is easing globally, central banks are closer to their final cuts, and the next liquidity wave is forming just over the horizon. As one hedge fund strategist put it this morning, crypto moves in the opposite direction of fear. When the world's nervous, smart money accumulates. And that's where we'll leave it tonight. Because while markets wobble and headlines scream, the long-term story doesn't change. Adoption keeps climbing, regulation keeps improving, and technology keeps solving the problems the old system created. As always, thank you for tuning in. Drop your thoughts in the comments, hit follow, leave that 5-star rating, and we'll see you at the top.